Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, yesterday was quite a doozy after PMI news and some other things that we got. Kind of a little bit of interesting action. So let's see if I can go over to the charts here, if I can kind of show you what I'm seeing here. So when we come over to the 10-year, like, man, oh man, did we have another rise in interest rates. So here was like the news is kind of where it happened. We were able to catch that. There was a pretty steep pullback, and then later on in the day, it just like totally slumped down. Now, one of the things that's curious to me about this move is that the volume was not that dramatic, really. I mean, of course, there was volume on it, but for the amount that, like for the change that we're getting, I kind of felt like it was a little bit light. So it looks to me like the liquidity might be pulling out of the market again. Or at least that's a concern on my mind at the moment. But when on the reports and so forth, a lot of the analysts were reporting that they weren't actually seeing that much participation yesterday. So take that for what it's worth. Here's the S&P 500 just getting absolutely demolished, but holding 4,000. So if we hold 4,000, there's actually still kind of like some favorable flows for us. But below that, things like really turn to shit. And I'm super, I really don't think they're going to be able to hold it, but we'll see. Here's oil down a little bit yesterday off of that. Natural gas just getting slaughtered here now. It's quite a bit of a further move down. Gold and silver actually weathering the storm okay. Of course, they got slaughtered back up in here, and then we got Kappa off of its highs from yesterday, but it was a pretty strong move yesterday in Kappa. And then we got Bitcoin. So I'm concerned for Bitcoin. If the S&P 500 drops below 4,000, I'm really concerned for Bitcoin, and I think that they could easily see new lows. So keep an eye out for that too. All right. Like, honestly, I was like looking at options yesterday and everything. I don't think that the trade makes sense, but I think that if the S&P 500 is going to go lower here, the play is to short Bitcoin because they've weathered this really well so far, and I really don't think that they're going to be able to keep that up. So that's basically where we're at here this morning. It looks like they're developing a decent range here off of the open so far. I do think that the play is going to be short still, but let's see. We got a few things here. We don't have any like 6:30 news, but we do have FOMC meeting minutes. Okay, so FOMC meeting minutes kind of can make things a little difficult to trade, right? And what I think is going to happen with the FOMC minutes is that, remember Messer told us that there was a compelling case for a 50 basis point hike. I think that you're going to see that in the minutes. I think you're going to see in the minutes that there was some members that were arguing for 50 basis points. And that could spook the markets, I think. Another thing I want to talk about here real quick. I'm sorry, I'm a little tired. I didn't get a whole lot of sleep last night. So if I seem a little off or I'm having a hard time speaking, it's because I just did not get enough sleep. That might be a good reason for me to sit on my hands today, even though I do kind of, I am, well, I don't know. I hate trading ahead of like an FOMC meeting minutes like that. But could move. It could move. And but the combination of that tough trading, slightly harder than usual trading, and me just like not having enough sleep, I can already tell it's difficult for me to speak and so forth. I might be less inclined to take a trade today than I normally would. Anyways, back to the chart here. Something. Oh, I missed a rollover notification. Yeah. So we are getting a little bit of steepening, right? And yesterday when we fell, the curve steepened. Not as dramatic in ZB. Okay. So the thing is that when like the recession is imminent, the curve steepens back out, right? So, but the curve may also be steepening just because they think higher for longer, and those 30 years are coming down harder. So some people might misinterpret the change in the yield curve. I think that if we're going to have higher interest rates for longer, then we're going to see steepening. But if we're going to have a recession, we might also see some steepening in those cases as well. But I would not get too excited about that unless you're seeing like steepening at the same time as treasuries bidding up and the S&P 500 going down. That would be like indisputable evidence that the market thinks we're going into a recession. Okay, so that's kind of the story right now. Well, looks like maybe a robot was able to evade my filters. Let's see here. The spam on Discord is just unreal sometimes. Well, I find that I got about 3 that will come in every day. I really find so I have theories about what might be causing it. I think that there must be some sort of like scam call center somewhere where they tell people to go around to these different discords, because I get the I don't remember why anymore, to be honest with you, but I've seen a couple of things that made me think it must be different people. So like one of the things that was okay. Yesterday was quite aggressive. I managed to go long several times on different scalps, but it took some balls. Oh, yeah. Well, that's interesting. Yeah, I felt that the recovery after that initial decline that I made money on, the $20 that I made it on, was really surprising to me, the pullback. And when it fell back down again, when they fell back down and breached the lows again, it was really aggressive. Like you said, it was really aggressive. But then I go on to Zero Hedge, and they were quoting like the Goldman Flow analysts and so forth, and they were saying, oh yeah, like we didn't actually have that much business come through our desk. People were calling and asking what's going on and everything, but we didn't actually see a lot of participation. So it seems to me that not everybody participated in that move, which is a little concerning to me, to be honest, because number one, even though we're seeing decent liquidity, relatively speaking, from recent action, seeing 2000s put up on there is good, but the orders were pulling out of the way, that the orders weren't holding. So that's the first thing, is that the liquidity is getting kind of flighty, and that can make things difficult for us, right? And then the second thing is if not everybody is participating, then that means that there could be a lot more flow to come. And in particular, in the S&P 500, if they make a convincing break of 4,000, there's probably going to be some CTA selling coming into this market, right? There's a lot of, this was another thing that Zero Hedge pointed out, but like if you're following these things, you should probably already kind of suspect, right, that we've had some of these things like CTA flows and all of these hedge funds that were short covering and so forth, that were kind of, tailwinds. They were pushing us forward, right? And now all of those things are kind of headwinds. Like the CTAs in particular, they've made their money, and any move up, they're kind of be selling against it probably, right? And if we turn around and we get below certain levels, all of those CTAs are going to switch and just sell this thing hardcore, right? So I'm concerned that if yesterday, well, I wouldn't say yesterday was the turning point per se, but there was definitely something different about the selling yesterday, and it really had me to a point where I said, okay, this no landing scenario is like becoming a major market narrative now, much more so than when it first kind of reared its head during the non-farms payroll, right? And so if the market turns into all-out bear mode again, it could be particularly ugly. The only thing that we kind of have that's helping us out here is that the sentiment is still awful. Like sentiment has never really recovered. Everybody is still bearish, and a lot of people are still positioned bearish. So the pain trade is still kind of to the upside. It's just that some of these other things in these flows are kind of conspiring to where it could be turning into a downside, right? So again, like it can move down when everybody's positioned down, but like who's going to buy it there at that, right? Then you could, yeah, I mean, or to put it this way, if we have a no landing, Federal Reserve has to increase interest rates even higher, and we get another major slump in the stock market based off of that, and possibly pushing to below last year's lows, like you're talking about something that's going to be really brutal. And like that would only be the beginning of it. That wouldn't even be like the recessionary part, right? So it has me a little nervous. And then on top of all that, as I mentioned yesterday, and I put in my TikTok, the China is dumping money into the markets. And so here we have this issue where everybody's having problems with inflation, and China's just printing more money and exporting their inflation all around the world. That is going to be a real problem. If I can pontificate politically for a moment, because I find this entire situation incredibly frustrating and distressing. Everybody blames it on the Federal Reserve. And like, look, I feel like, of course, the Federal Reserve makes mistakes. I think that they're really trying super hard, but I think the nature of the thing is that you're going to be a little bit behind because you have to be risk adverse with what you're doing when it affects the whole economy, right? Meanwhile, these politicians get off scot-free. Okay, politicians injected all this money into the economy that created this situation in the first place, and now because they did all of that, our options now to deal with this problem, if we're going to have a second wave, are extremely limited. And the reason I find it so maddeningly frustrating is that we solved this problem once. We dealt with this problem for a whole decade or more back in the 70s. And it turned out the solution was you have to stimulate supply too. And they absolutely refuse to do anything on the supply side. They all come out, all the analysts come out and like pretend like, oh, you can't do anything about supply. Supply is just its own thing. No, you give them money and you have them increase their operations and produce more stuff. And then when they produce more stuff, they hire more people, and that's more people that can meet that demand when the supply increases. It's much more sustainable stimulus that includes both demand and supply side stimulus is much more sustainable. We've solved this problem, but for some reason, one party has refused to acknowledge the economic history and is playing dumb. No, so the supply side stimulus does not necessarily mean cut taxes on businesses. In fact, in this situation, I'm not sure that cutting taxes on businesses would help. So just look at the UK, right? They came in and they said, well, okay, we need to do supply side stimulus, so we're going to cut taxes, right? And then it was like, no, that's not okay because you're going to be taking in less revenue from the government. That's going to increase the deficit, and that's going to make your interest rates even worse, especially if we're already having inflation. Okay, like having a big deficit is like you can kind of get away with it when the interest rates are already low and nobody's worried about inflation. But when everybody's worried about inflation, that's just like one extra pressure that's just going to make things that much harder for you on the interest rate side. Okay, so when we're talking about supply side stimulus, it's going to be anything that increases supply. Okay, so yeah, you could give a tax break, right? A tax break would be a way to try and like give like an across the board stimulus, right? But what I would instead be doing is I would be looking at where the specific bottlenecks are, right? So for instance, if we're not producing enough food, right, then I could give subsidies or incentives for people to produce more food, right? And it doesn't necessarily have to be a tax break, right? And in fact, I personally would favor the other ways of doing this much more so than the tax break thing, because here's the problem with the tax break thing is that you're just giving them money and then hoping that they do the right thing with it, right? So it's much better if your stimulus is attached to the exact thing that you want to stimulate, right? So they're not going to get a tax break, they're not going to get money, they're not going to get any advantage unless they do the thing that you want them to do, which is you put it into hiring more workers, you put it into producing more product, right? Like if they take that tax cut and then they turn around and they buy more shares with it, right? Then it doesn't help us, does it? No, they don't know how to do the right thing. I mean, so like this is the problem, right? Is that incentives aren't necessarily aligned, okay? what especially when we're talking about a corporation, okay, what is best for the corporation and the CEO and the investors of the corporation is not necessarily the best for like the nation's supply as a whole, right? CEO just wants the stock price to go up. It's kind of turned into this thing where it's like they don't care what you're doing. Like, look at Elon Musk, because they don't care what he's doing, how crazy it sounds, or whatever the deal is, as long as the stock price is going up. And if you're doing crazy stuff, but it's getting interest in your stock and your stock is up, then everybody's happy, right? But you're at the same time, you're possibly making all of these decisions that harm your business in the long run, right? You're taking short-term profits at the expense of the long-term viability of your business. And corporations do this all the time. And so you have a lot of situations where it's like, yeah, they have money, like they come in and they get like a windfall profit. Oh, why don't you, work on using that money to get better talent and to retain the talent that you have better, or to just hire more people in general. And that would allow you to make even more money. It would allow you to produce more goods and do things more efficiently. And what do they do instead? They buy their stock, right? The incentives aren't aligned. So you need to craft the stimulus in a way that it directly incentivizes them to do the thing you want them to do. Right? Otherwise, what you find is that the stimulus is not very effective. Well, I don't want to listen. I own the business. I go and I buy the stocks, right? But I mean, if they go and they buy back the shares, it's good for me, I guess. But you get what I'm saying? It's if you need you need more supply, cutting taxes doesn't necessarily create it, right? The less targeted your stimulus is, the less effective it is at stimulating the thing that you need. And if we need to specifically stimulate supply, just an across the board tax cut isn't very good at that. Like, so there's this whole field of Keynesian economics where that's geared towards measuring. Oh, by the way, I have my new squawk on. There's the whole thing in Keynesian economics is to say, here's a stimulus, like what's the multiplier on it? Okay, for every dollar that we spend on this stimulus, how much money do we get back from that investment? Right. The thing that has always shown to be the highest multiplier is unemployment insurance. Okay. That's why we always have unemployment, and they tend to increase it during recessions, okay? Because according to our models and in practice, based on, what having done these things and looking at how it affected the economy, the thing with the largest multiplier is unemployment insurance, right? Okay. So now on the split side, the stimulus that in that situation conservatives always want is a tax holiday, right? They always want a tax holiday, or we just reduce taxes in general. And the multiplier on that is not very good. In fact, on many of those proposals, the multiplier is less than 1, which means that you're putting more money into it than you get out. Like, it still has a stimulative effect, but you're just increasing your deficit in the long run, right? Like, you're not going to get enough growth to justify the spending from it, right? So, and then you couple that on top of that the deficit is already high and the interest rates are raising. It just reducing taxes isn't a very good idea, right? So you're gonna have to go about supply side stimulus, looking for things that are more targeted in the hopes that you get a higher multiplier from them, right? Yeah, the left definitely does love Keynesian economics, right? I mean, that's really the ultimate problem in the modern economy, right? The big problem with the modern economy is that Keynesian economics work, right? Like after 2008, It used to be for decades and decades, there was this big argument out of it, right? After 2008, you really couldn't argue it anymore. Keynesian economics won. It was undeniable at that fact that stimulus does help grow the economy, right? So we have already kind of moved past that argument, and the argument is now what kind of stimulus is appropriate, right? The argument that I'm making is that you need to have both supply and demand side stimulus, and that supply side stimulus should not just be cut taxes. That's what I'm saying, right? Because what happened during the whole COVID thing? We gave people money directly. So we did the most direct kind of consumer demand stimulus that you can possibly do, right? And what happened? It worked, but because we didn't do anything on the supply side, all it did was create inflation, right? It didn't really help us in the end. I mean, it was nice for a year. The economy was great for a year, and the stock market went crazy, and everybody did a bunch of stupid stuff. But it didn't solve the problem. Created inflation in the end because the supply side, the transportation, couldn't keep up with it. So as an example, like what would be something that would be supply side stimulus that we could do? Well, how about we put more money into our shipping infrastructure, right? Because our ports clearly could not handle that much demand, right? That would be like a direct supply side stimulus. Get what I'm saying? They try to decide which sectors of the economy deserve. After COVID, they didn't really do that. Like just realize that the COVID stimulus was almost 100% demand side stimulus. Like there was the whole the PPP plan, right? I guess, but like hardly any of that money actually went into developing businesses, right? There was massive fraud. It was a huge waste. Okay, so and I don't think that you really can say that ended up being supply side stimulus, right? Everything ended up being demand. It all just went in and people bought more stuff with it. We bought 20% more stuff. So that's so much that it has to be a combination of both people, holding back their purchases or bringing forward their purchases and kind of timing them all in that time when they had the money. And then on top of that, they had the more money because of the stimulus checks, right? So we're buying 20% more stuff, and then the supply chain can't handle it. And that's what caused this, right? Yeah, that's where Keynesians feel stronger in demand stimulus, not supply. Absolutely. Well, one because I don't understand this one. No, I do understand this one. Democrats hate business. I don't know any other way to put it, right? The Democrat Party hates business, right? They hate business up until the point that the politician is given money by them, and then and then they do whatever the business says. But in general, the attitude in the Democrat Party is they hate business. So if you propose any kind of bill that's going to help business, your constituents hate it. So it's really hard to get any kind of supply side stimulus passed, right? But there's another problem with supply side stimulus, and that is that supply side stimulus is not as immediate, right? Like if I go and I give everybody $1,000 check, you're going to see that right that month. And you did, right? Do you remember when that stimulus happened and you'd go to Walmart and like the aisles were just full of TVs? Like the Walmart just stacked as just put out as many TVs as they could, knowing that that's what people were going to come in and buy. And they did. They did, by the way. Like, remember us being so cynical about it? Like, is that really what people are going to do? They're going to waste it? Because I put it in the market. But, yep, that's exactly what they did. They wasted it. They bought TVs with it, right? That happens immediately. If you do supply side stimulus, that takes time, right? Like if I get supply side stimulus to increase the ports, for instance, right? Then I'm going to start a big construction project, increasing the size of the port, or upgrading the technology to make it more automated, or whatever the deal is, right? That you're talking about like possibly a 5-year project, right? You're talking about possibly a 5-year project, and it takes time for supply side stimulus to be seen, right? So that's the other problem with it. Now, in this situation, this is what makes it so maddening. It's the part that drives me crazy about it, right? Is that we have China exporting inflation all around the world, and we have millennials coming into their peak earning spending years, right? So we're going to have in the next 10 years more people spending than possibly any other time in human existence, before or after, okay? Because all of the demographics say that the population is going to decline, and it's probably going to even flatten out at a slightly lower level as even as undeveloped countries become more developed, right? So we are literally living in the time where there is going to be more consumption, more spending by people than at any other time in history, right? And the supply can't keep up with it. And the one opportunity that we had to maybe prepare ourselves for that and increase the supply, we blew. They didn't do it. So now we're looking at a situation where, inflation could be a persistent problem for a decade, right? And then on top of that, deglobalization, right? Very frustrating. I'm very frustrated by it. I kind of thought, well, things can moderate. Maybe we'll have a little bit of another move down here early this year. And then we can kind of like even things out. And then hopefully there's enough political changes that next cycle we can maybe try and fix some of these problems. Now what I see happening is we have to accelerate the interest rate increases. That maybe there's a fall in the later half of the year. That's what a lot of economists are predicting, or whatever. But I think that it's going to be a much more persistent thing. It's going to be like, okay, you're going to clamp down, and then it's going to do this whole cycle again, over and over again for years, to the point that by the time you get to the 2024 election, there's going to be a lot of social unrest at that time, and then who knows what happens then. Okay. Question: when trading treasuries only using the price ladder, you're looking at ZB, ZN, ZF, and maybe ZT or UB. What's the correlation you're looking for? Okay, that's a great question, Virus. Okay, so I have my treasuries ordered in a certain direction for a certain reason. Okay, so if I come over to my chart, if you look at, for instance, well, I might have to zoom out to see them. I don't really get a good example. I'll just make this chart bigger. This data series down at the very bottom, that's kind of this one that's like really tight, squiggly line, yellow line. That is the spread, okay? This right here. That is a spread. So that is the 2 and 10 year spread. So it is you buy 4 ZN and you buy 4 ZT and 2 ZN is what I think it is right now. Okay. And you notice it's moving up. Okay. So moving up on this chart means steeper. Steeper. Okay. What do we mean by steeper? Steeper means that the yield curve, I guess I need to do it like this. The yield curve is shaped like this, right? Flatter is the yield curve is like this, okay? Steeper is like this. Steeper is like short-term interest rates aren't very high, but longer-term interest rates like the 30-year is high, right? But it could also mean you're relatively flat, and then these short-term rates come down. But it could also be you're flat and these long-term rates come up, right? That would be steeper. But when the slope of it is moving in this direction, right? Steeper. Okay. So I have my treasuries positioned in order so that they move the same direction as that chart, which is to say, up and to the right is steeper, right? So do you see here right now, the 5-year is up like 5 ticks, the 10-year is only up 2 or 3 ticks, and the 30-year is only up 1 tick, right? That means steeper. I have it so that the direction on my chart and the direction on my DOM is the same. I also have it because I have these micros down here too, right? See, they're the same direction. Steeper, right? So I know in my head, what are some things that could cause things to get steeper? Okay, well, if people think that the Federal Reserve is going to start lowering interest rates or that there is a recession coming, then things will get steeper, right? But the other thing that will make things steeper is if they think that interest rates are going to be higher for longer. Yeah, I haven't centered the ladders in a while, so while we're discussing this, I'll kind of leave it alone for a bit, right? Okay. So those are kind of like the situations where we're going to be steeper. The flatter is going to be when the Federal Reserve is raising interest rates and the economy is doing well, and as the economy does well, you see that curve flatten out, right? Right now, it's so flat that it's inverted. Okay. So when you talk about correlations, well, so first of all, they're all going to move at the same time, right? And I'm going to pay attention. Like if I see price tick up, so like right there at 05 half, there's only 200 on the offer. They ticked up, hardly any stacked on there, right? And then it comes back down. And you notice that the 5 and the 30 don't even react, right? But sometimes you might see all 3 of them tick up at once, and they all hold strong bids at the same time, right? That's usually a strong indication that either one, there's like been a change and somebody's like really strongly buying, or 2, that there's a correlation with like the dollar, the Japanese yen, or whatever that just changed and that they're all reacting to, right? But it's a stronger tick when they all tick together, right? But the other side of it is, if I know what the spread is, I can kind of anticipate what the flows are going to be. So if we just go run along with that today we're steepening, right? Then when I come back to the chart here, okay, what should I expect to see in the cumulative delta? Well, I should expect to see more buying in the 5-year than in the 30-year. And you can kind of see that. So do you see how the 5-year here, they kind of flattened out after this? Like there was a decline, but then they flattened out after this. When you look at the 30-year to the same point, this is the point at which they started flattening out, right? The 30-year actually sold even more, right? Why? Because of the spread, right? The people are buying the 5-year and selling the 30, right? So I can kind of discount some of the flows that I'm seeing here, right? If we're moving up, I can't just look at the 5-year and say, well, the cumulative delta in the 5-year is long, so that means I want to go long, right? Because the cumulative delta in the 5-year is going to be slightly biased towards going long simply because of the spreads. So I kind of have to discount that a little bit. Similarly, if we're seeing selling and I'm seeing a lot of selling in the 30-year, I kind of have to discount that because they're buying the 5 and they're selling the 30. So selling in the 30 is not as conclusive of an indication about which way the orders are going as one might think, right? What I would prefer to see is, like, if we're buying here, to see all 3 of them moving in the same direction with a pretty strong correlation, you know? My cumulative delta, just a nice steady line moving up, right? Which we don't quite have but we are getting some degree of buying coming into this market. So, right. So that's why we need to have the multiple instruments up, right? Is because number one, I can see when this ticks up, do these react, right? What's going on here? What do they think is fair value? Is that tick up? If the other two didn't react to it, then that probably means that it's not a really significant thing, right? And it might be able to alert you to places where, like, which prices you might actually be able to get, right? But then you also need to use it to be able to judge the strength of the flows, because yeah, you're going to see buying in the 5-year. So if you don't realize that part of it is the spread, you might think that the uptrend is a lot stronger than it really is. Right. Right. So the 5 delta being flat and the 30 sold more, are you at the time looking for opportunities to buy the 30 for more buying to come back in it? Not necessarily. So the key thing to all of this, and kind of the thing that I'm going to tell you that's not what you're going to hear from most people, okay, is that the data that comes from the exchange is usually not enough to base an entire trade on. Okay, there are some situations where the market is really active, where you can find these small little trades in the treasuries that are really, really reliable, but they aren't worth very much. They're kind of high risk. And sometimes the flows can just be really, really random, right? What do we need to take a trade? We need to have information that will strongly predict future orders, right? If I buy the 10-year, I'm going to need to see other people buy behind me to push it up, right? Where are those other orders going to come from? What do I know that says that those other orders are going to come? Well, there can be all sorts of information that you can use, actually. So the big one is the news, right? So let's review. What do we got for news today? Well, there's nothing too significant on the docket this morning. We do have a 5-year note auction at 11. So we do want to keep an eye out for icebergs and other kind of weird behavior that they do on auction days in the 5-year, right? And we'll probably see those in not just in the 5-year, but in the other instruments as well when that happens. And then the other big thing that we got today is an FOMC. So the market is very concerned about the Federal Reserve raising interest rates. I'm concerned that we're going to start pricing in the next rate hike might be 50 basis points. So for me today, I think I'm much more biased to the downside, right? I'd be looking for large institutional trades selling, right? But guess what? That's not what they're doing right now, right? They're coming up. The cumulative deltas actually look pretty good. The 10-year is almost at its highs on cumulative delta. So I based on the cumulative delta, I could go long. I could go long in the 5s, right? But because that's not in line with the flows that I was expecting, I ignore it. Right? I would say that the flows that we got were pretty contradictory to the scenario that I was looking for. So I don't have a scenario anymore, right? In order for me to go long, I would have to have some reason to think that they're going to be coming in and buying today. And for all I know, this is just random noise or speculators buying it or something like that, right? Okay, so I don't sell any courses, but I do have two videos about trading the treasuries in particular where I cover some of this stuff. And it's a pretty good overview, right? The other thing that you need to know about the treasuries is they're the other correlations. So there's a pretty strong correlation between the treasury and the Japanese yen and the treasury and the dollar in general. There's also a tenuous relationship with the S&P 500 that will flip based on the situation, right? So if the market is rallying because they think interest rates are going to be low, then you tend to see them move together. Whereas if the market is concerned that things are getting too hot, then they'll move opposite each other, right? So, and then I have a video series about how to read the order flow. And I have in those videos, we kind of talk about some of the stuff about why we don't just utilize the market information alone, right? So the problem is like by the time a trend is obvious, so like right now is actually a really good example, I think. So when we opened up, we ranged a little bit, and then there was a little bit of a sell, right? And now we have come back into the middle of that. I would say that the volume on this up move has been pretty good. But it's not enough for me to say, oh yeah, this is like a clear uptrend. It's going to like uptrend all day, or at least until the FOMC meeting minutes, and I really want to jump on board this sort of thing, right? Like this is a spot where I get in at 06 half. The chances of them falling back into this hole at 05, really high, right? So the reason I say 05, one, because there was a lot of volume that traded there, but also because when we first started talking about this, remember we were saying they weren't putting very much liquidity on it. There was only like 200 contracts. Well, that was happening down here. So there was an area of lower latent liquidity, 05 half. So you might get sucked back into that, right? So if the market does turn into like a strong uptrend, where would it happen? Well, we could say, let's say for the sake of argument, that if they trade above 09 in the 10-year, then we're for sure in a strong uptrend, right? And the thing is that by the time, if you use that as a trigger and you buy there, by the time you get up and you buy there, that's like probably going to be like exactly where it pauses, and then you're stuck in a position for 45 minutes, right? So if you're relying purely on the trend, well, there they came back to 05. Okay, if you're relying like purely on the trend, the problem is that by the time it's really clear that it's happening, it's too late, right? So the better approach here is to have information that suggests which way the flows are going to go before you see them, right? And then you can try and then as soon as you see anything that's kind of even remotely confirming to it, you can try and jump on that trend and ride it, and you'll be able to catch the whole trend, right? And then when the trend becomes obvious and you get to that point where everybody tries jumping on it and it like stalls out, you're exiting, right? And that's how I try and play it. But in that order flow series, kind of discusses why we approach it that way. And I got another video coming out next week, hopefully, that I'm going to have a PDF that's going to have like tons more information in that, right? So anyways, long story short, no courses, just go and watch my full long form videos, and it's got everything you need. Which is really a better deal anyways, isn't it? Right? You can go and learn it on your own time. You don't have to pay me anything. Man. So that was a good little segment there, but I am so tired. My child kept me up so late last night. You can't find any articles or videos or articles to teach how to plan out a trade. Yeah, it's frustrating because what happens is people want technical trades, right? They want, okay, when this moving average crosses over this moving average, then you buy, and then this is the target and the stop that's what people want, right? And so if somebody is going to provide that, they put it in some sort of a course and then they charge you for it, right? They charge you for it, and then they don't give you any statistics about how it performs or anything like that. Right? Whereas what I'm doing is I'm kind of coming in and saying, here's the things that we know about the market. So there's a lot in that order flow series about the different combinations of things that you can see, and then like what are the kind of proven tendencies that we know that the market has, and how you can kind of adjust yourself, how you can kind of position yourself tactically to take advantage of those. Okay. But then in terms of like what's going to get you to buy or sell, it depends on the day, because it depends on what's going on and what information you have, right? So there's not, it's a discretionary system, right? So I'm telling you, here's all the things that you kind of need to incorporate into your strategy, but I can't give you like specific setups or anything like that, because specific setups don't work, right? So yeah, that's what you get, all this stuff where it's all nonsense and it's all behind a paywall, and then there's no actual good information out there. And I know it sounds like super egotistical, but I feel like I'm the only person out there that's putting out any kind of content that's actually going to be useful to you guys. Yeah, I actually want to learn about things specific to the treasuries to help see the order. You know what I mean? Yeah, exactly. Well, so the things that I would focus on, and this is kind of hard. I someday I want to write a book, and hopefully over time, as I write a book, I can make sure that we get all of this information in there. But what I found is the best way to learn this stuff is to just kind of learn it as you go. You get involved in the treasury. You don't have to trade live at the very beginning. You can trade sim. You can trade sim for years if that's what it takes for you to get some good performance underneath you, to where you can really hold risk. Okay, but you and then you come in each day and you see what the situations are, right? Because there's just so many of them that it's hard to like enumerate it all, right? Like the way that the treasuries. So I'll tell you, when there's an auction, you will tend to see really bizarre large trades happen. Sometimes with like ginormous icebergs in the treasuries going into auctions. There's also a tendency for the treasury market to move up, especially after an auction. Because it's like, it kind of comes down to absorb that supply, and then they move up afterwards because the big bad event is over. But it hasn't been that way lately when we've been in this really aggressive tightening environment. Okay, but statistically, treasuries tend to buy. There's a study in the futures trading education, you go back far enough, that proves that one. Okay. And then there's the FOMC meeting minutes, right? That's a really critical piece. So we already had the FOMC meeting and we saw what the result of that was, and we had a press conference afterwards, but now we get to read the minutes that they wrote down about what actually happened in the meeting. So sometimes we get some more information, and that can really move the market, right? So those are two things that we have today that are good to know specifically about the treasuries, right? Ooh, while I'm thinking about it, another thing that would be good to know about treasuries, the market in general tends to have more liquidity at round numbers. So like at 4,000, I'll be really shocked if the S&P 500 trades down to 4,000 and there are not multiple thousands traded there. Okay, there's going to be liquidity at that 4,000. Okay, and so much so that the robots kind of go along with it. That it's like a human created, I don't know if you want to call it an inefficiency, but a human created thing, and the robots go along with it. Okay. Well, what is it in the treasuries? Well, obviously 111000 would be an even number, right? But another even number would be half of that, right? 16s. It's always fishy stuff going on at 16s, especially at 16 in the 30-year, man. Some of the most frustrating trades I can remember was when I was in a trade and it started dinking around at 16, right? And then quarters of that also. So like 08 and 24, right? Those are the round numbers in the treasury. So there's another thing specific to the treasuries that you might want to remember. That's all I can think of right now. Yeah, if you go to the channel, there's an order flow DOM playlist. What's the specific name of it? The Treasury ones are not in a specific playlist, but they're relatively recent. I mean, if you come to the videos, I don't have that many videos on here. Okay. 5 reasons to trade micro treasury yield futures and how to trade Federal Reserve policy. Those are the two about the treasuries. Right? And then these ones over here, these are the order flow ones. But you can come over to playlists. You see it, order flow playlist. Right? So it's all there. It's all easily laid out. It always feels good because there's a couple of things that we talk about here regularly that we're going to try and get out in the next 3 to 5 videos. You know, but we really have a really good solid slate of content. Like I have that series of videos. I have that series of videos that will be good for years and years and years. You know. Yeah, don't go watch them right now. Do you think that they're gonna? What do you guys think? Do you think that we're gonna breach 09 eventually, or you think we're just gonna chop around in here? Geez, yeah. So again, the volume in the 5-year looks incredibly strong. I would say in this case, you know, over the last 30 minutes, all 3 of them have been seeing an order imbalance to the long side. So I don't know if it's enough to really give us any kind of a good trade. I think that the situation that we have right now, I'm really going to need something that really flashing red flag that says something's going on, right? We do have the equities opening in 10 minutes though, so that could be interesting. Let's go to Zero Hedge and see if they got new headlines here. Study finds people with higher cognitive ability care more about free speech than political correctness. Too long didn't read. The woke are dumber. Okay. That's funny that somebody did a study about that, but JP Morgan curbs employees' use of AI. Oh, I'm sure. So did you know with ChatGPT that basically every question and response that you give to it could potentially be looked at by a person and the response judged? So the reason that ChatGPT is effective, because these kind of GPT language models have been around for a while. The innovation that they made was they hired a bunch of people to go in and ask its questions and rate the responses that they got from it. And then that information got put into the model. Right? So whenever you do something, somebody is going to go and look at it and say, okay, did ChatGPT have a good response or not? Right? So if you work at a bank, yeah, they're super cautious about making sure that no information gets out, right? So people are using ChatGPT and that's going to be looked at by somebody. That's a no-no. Big no-no. Zero Hedge also has an article trying to pump gold. Gold investors are betting the Fed will continue to be negligent with its monetary policy. Yeah, that's why it's down $200. Actually, it's not that bad. 1850 is not that bad. It's about where it has been. And they're probably right. There has been like overall buying over there still. It's just to get slaughtered every time that the interest rates rise by the correlation. China Foreign Ministry, China is willing to work with Russia to deepen political trust, extend pragmatic cooperation, and play a constructive role for both countries in promoting worldwide peace and development. Oh yeah, I forgot it's snowing. I never went out and looked at how much the snow was. Oh, your niece's fiance is a coder working with the ChatGPT? Interesting. Very interesting. You know, it's so interesting to watch the internet response to this, man. I don't think I've ever seen something where everybody was just so immediately like, oh, this changes everything. You know what I mean? Like when Facebook became a thing, people slept on it forever. Forever and ever and ever and ever and ever. When TikTok became a thing, like TikTok had been out like 2-3 years before it became big. ChatGPT, it's like they released it and like that week, huge internet sensation. Well, part of it is that ChatGPT is free. But still, like everybody's, and you know what else is interesting about it is like if you go on TikTok, there are so many people saying, look, here's how you can make money easily using ChatGPT. And I'm just like, okay, so why are you telling us? Why don't you just go do it yourself? You realize that the more people that you tell how to do this, the less money you're going to be able to make from the services that you're providing using it. So if it's so effective, why aren't you just using it? Seems to me that there are more people trying to educate you on how to use ChatGPT than there are actually using it. I think that the world is really sleeping on where artificial intelligence is going to have the biggest impacts, right? And it's not necessarily going to be with ChatGPT. It's going to be other models that require a little bit more advanced knowledge of the actual subject matter that you're looking at and how to correctly apply the machine learning to those applications in a customized solution, custom to the specific problem that you're trying to solve. And that's where you're going to see these insane efficiency increases. Yeah, a trading bot using ChatGPT, that one drives me crazy. So many people, even people that aren't into trading, say, oh, let's have ChatGPT build as a trading robot. Okay, it's going to write the worst trading bot ever, but go for it. But at the same time, it's kind of funny. I don't know. I've kind of gotten into the mode where I just don't care anymore. like I used to be, okay, there's disinformation, like we got to come in and say something about this, right? Okay, here's 09, by the way. Here's 09. Could be fun. No, so I used to spend a lot of time worrying, trying to counter misinformation and give people more correct information about the markets in particular, right? And now I'm kind of like, well, the people that really care and that really need this information, they're going to find it. The people are searching, they're going to find it. And if they can't find it, they probably don't deserve the information. Like they're not really going to be able to take advantage of it. They're too stuck in their current paradigms. They're going to waste it, right? It's like, don't cast pearl before swines, And so when I see people, I might leave a comment, but I did make a video about it. I guess I'm not as I don't care as I think I am. But like, for instance, yesterday, I really think there's a compelling case. Oh, it's not as good as it is now, as it was, but I think there's a compelling case to be short Bitcoin right now. Of course, I would never be short Bitcoin with leverage and everything, because that thing can just like rip your face off. But like, if you have a way to do it with options, for instance, you could do like a YOLO trade on MSTR. They have option strikes all the way down to 0 on MSTR. Can you? Believe that? So you can go and spend like $30 betting that MSTR will go to zero. But I think there's a compelling case because from a valuation perspective right now, Bitcoin is really high and it came back to that really high incredibly fast. And we're looking at potentially a market that is bad for risk assets. And the S&P 500 has fallen really hard, but the Bitcoin didn't really follow it too hard. So if the S&P 500 fails 4,000 and accelerates, maybe Bitcoin will come down, but it might take a little bit longer. Bitcoin's going to lag it, but eventually I think you're going to get a really good short trade over there. And if it does turn really bad in Bitcoin, I'm going to bet you that there's going to be another sort of blow up because that space hasn't been completely cleared out yet. So I see a compelling case to be short Bitcoin. And so I'm sitting there like, oh, well, we should tell people. But then I was like, yeah, but then I'll get all of these Bitcoin adherents on TikTok following me that annoy the F out of me. And I just don't, no thanks. So I just didn't make the TikTok. He coded a bot to trade the S&P. He seems very happy. Well, I tell you what, you can definitely utilize machine learning to enhance your trading strategies. It's just with the way that ChatGPT works. ChatGPT is never going to write you a very effective algorithm because it's only going to give you code that's like freely available on the internet. It's going to be drawing from sources that are on the internet and doesn't necessarily have an understanding of the markets in general and how to best apply it. So when you ask it for a trading strategy, it is going to give you like an RSI strategy or something like that, right? Hey, 330, welcome back. Oh yeah, did this person give me that name? How are they doing that? No. Pep, yes, I can see you. Oh, your YouTube is being weird. This must be the one where they create a second account so that we can't see who they are, and they use that to figure out who to message. Somebody messaging me that they were getting spam, but they were never on our server. The person that was sending them the spam was never on our server. So we just have to report the imposter, I guess. Oh, okay. So they did make new highs, kind of a little bit. Seems a little bit uneventful though. I didn't see like a huge increase in cumulative delta going through it or anything. There are some targets up there above us at like 11 and 12. I don't think I'm willing to put my own money on the line here in this situation, but we might be able to try some scalps. Sure. Okay. So you're saying like a novice discovering the MACD, calling a market oversold and buying the market bought based on RSA. Yeah. Like that's what, so there was a guy on TikTok. There was one in particular that was like, here's the bot. And then we tested it. So he went into TradingView and tested it. And yeah, the TradingView back tester has never been very I wouldn't trust it. Let's just put it that way. I wouldn't trust it. I'm pretty sure that there are ways to make sure that the results that you're getting back from it are accurate, but it seems like the way that the backtester works is a little bit more hidden from you, and so it's a lot easier for a retail trader to not realize where they're doing things that are kind of cheating the robot. You know what I mean? Anyways, there was these guys and they're like, we back tested it and here's the results that we got and it was super profitable and everything, right? But when you actually like dig into the stats, it was actually a really poorly performing robot that was like had like huge drawdowns and the win rate on it was terrible. But like that's the whole thing, is that the market is really good at fooling us. Like if you come in, you don't know anything about trading, okay? If you don't know anything about trading and you say, here's how I'm going to trade, right? Whatever your first intuition is, whether it's a discretionary or a quantitative strategy, whatever your first intuition is probably dead wrong. That's the nature of a competitive market, is that the obvious things have already been done and taken out of the market. So you really have to do something counterintuitive that most people aren't going to think of to make money from a quantitative strategy, right? And the whole thing is that the market is really good at providing people the stats that they want so that they trade it, and then when they start trading it, they lose the money, right? The market's just very, very good at fooling us. It's a snow day. Most people I know of, what they tell me their first intuition when they started out was to just buy the whole market and sleep. Well, I mean, you can do really good if you just buy and hold. I think I'll hold 1 for if they bust through this 11 here. Because that was a pretty strong uptick. Yeah. Okay, so now they're kind of playing that game where they're realizing that the offers aren't just going to pull, and they have to amp up enough courage to hit them. Well, that's not necessarily what you want to see, is it? The other day I was following a bookmap channel with audible icebergs buying. Meanwhile, the market was tanking and the chatters were upset. I bet, man. Iceberg is like one of those best examples of something that like you will find a period where it worked really, really well, and then you'll find a period where it works really, really terribly, and the market seems to shift between modes at random. Yeah, I think that's what he was saying. I think he's saying that they saw the icebergs and so they tried buying them on the S&P 500 bouncing. Because that's what all of the bookmap guys that trade the S&P 500 think happens. So I'm telling you, it lies to you. It effing lies to you. So like, here's the thing. If where would be a good example? So like, if you look here on the S&P 500 at 4006, there's 722 contracts. That's not too crazy, but it is more than anywhere else on the DOM there, right? So like, when it turns around, it usually leaves some liquidity there. Usually there's a bunch of orders that just hang out there for whatever reason. I don't know if it's like the robots stacked there, because it was close, and then because they stacked there, they just left them there, or what. But so when you look at it on the book map, right, you're going to see it come down, and then after that, you're going to see a line. And so what it appears happens is that the market firmed up at that location and showed you the higher liquidity and absorption in that area, and then it bounced. And so that's what they think happened, right? When because the chart is not granular enough to show you that what actually happened was it bounced first and then you see the liquidity after it, right? And so then they get into this mode where, okay, I see a big order down there. It's probably going to bounce off of that. And if you watch that, you're going to see it a lot where it does do that a lot. But like I said, it goes through regimes where it does that. And it's hard for us to see the whole regime. So you think, oh yeah, it totally bounces off of it every time. And then you're going to get a day like what Lafta was explaining, where it just fails over and over and over and over again, and you get absolutely demolished. Why? Because the market is very statistically efficient. Do you notice a lot of spoofing in the trading in the treasury? Yes and no. So after they started prosecuting it, it definitely decreased, like big time. There was a lot less of that stuff after they started prosecuting it. So I'm pretty sure that there was some large institutions, big guys that were kind of utilizing those kinds of strategies, and they stopped doing it. But I still see it occasionally. And what will kind of happen is I will see a really obvious spoof, and maybe I'll see it a few more times that week, and then it kind of disappears again. So there's no spoofing in the treasury market, and if anyone tells you otherwise is lying, or they think they spotted a spoof or you're missing something. Yeah, well, there is this other issue, which is like, you might see a really suspicious order, but how do you prove that it was a spoof? There are some situations where I can say like that. I think that was a spoof, but a lot of the time what I will see happen is, like, say for instance, there's 3,000 contracts at 11. Something that you might see sometimes is all of a sudden it'll only be 1,400, right? But when it actually does trade through it, you'll still see more than 3,000 contracts traded, which suggests to me that somebody pulled their order because they thought that their liquidity resting there was preventing the market from going through it, but they didn't like pull the order, like they just converted it into an iceberg, or they just canceled some of it and then started executing when it went into, I find that happens a lot. Tariq Assad, I am 17 and I found a big interest. Okay, so if you're a kid, man, what I would be trying to do is trying to, go to a really, really good school with a good graduate program that would give you some sort of an in to one of the big institutions where you can do like real trading. So unfortunately, I don't know what the best path for this is because I didn't do it. um, but definitely if you get into one of those Ivy League schools with the big business, there's like the big 7 business schools, that can really, really help. Another thing that you can do though, or what I might suggest you do is like, um, I really like to read market research. So at 17, I don't know, you might be able to do it. And it depends on how far into math you went, right? If you've done calculus, then you might be able to follow some of the research. But then you go and you read research studies, and then you go and you say, okay, who wrote that study that I like, and where are they at? And you try and get into that school, right? That might be an approach. And then, like I said, out of school, you can either get hired by a firm like that, or you do research that, you stay in academia, you do research that's really big, and then you get picked up that way. Right. So that's like the best path, I think. Okay. Is if you can do real trading for a firm. That's so much better than what we do retail trading. But it's competitive. It's hard. It's hard. Yeah. And let's see here. Go to Optiver's website. They have a list of target schools they recruit from. Just do a math degree from those schools and apply to every firm you can think of for internship in your last year. Yeah, exactly. Yeah. So I don't know, where do you live, Tariq? That would be the critical factor is, if you're in the United States or which state, or if you're in Europe, that would make a significant difference, right? And the other thing is that, that might be expensive, right? And maybe you can only afford to go to your state university. That could still work, but you just kind of want to know that the gateway through this is like either doing finance or a math degree, and there are some programs out there that are doing like quantitative finance sort of programs now as well. So if you can find a place that's doing that sort of a thing. Yep. Or just know people. Yep. But I mean, the thing is that there's not that many people doing this stuff. I mean, it's insanely competitive, but it's insanely competitive amongst a relatively small group of people. So if you, at the age of 17, know that that's what you want to do, is you want to be a trader or a quant, that gives you a huge leg up on everybody else. And if you go forward and you talk to all your school counselors and the university recruiters and everything about what your goals are and get the guidance from them, you have stand a really good chance of meeting that goal. You really do. So that's the way that I would go about it, and make sure you do good in your math classes. Right? This little piece of metal kind of broke on me. Time to just throw it away. What is the top Ivy League school for finance? Just curious. Well, so I think it's Harvard Business School is the most prestigious one, right? So in terms of like market microstructure research, I think that it's the University of Chicago has a pretty good program. UVA, Oxford. Yeah, Carnegie Mellon is definitely one of them. Chicago and Sorbonne, I'm not familiar with that. Wait, UVA, University of Virginia? Oh, you must be talking about European schools that I'm not familiar with now, huh? Well, so can I say another one? I don't what or tell me what you think about these. So one is MIT. I don't know if MIT has any good quant finance stuff or not, but you would think that they would, given their reputation. And then the other one that I get is I get what is the name of this place? Berkeley. Yeah, I get stuff from Berkeley. You say FMIT. Okay, Berkeley has a quantitative finance graduate program that they keep sending me promotional material about. What do you think about that one? Now, if I lived in Europe, I'd be trying to go to Paris because all of the cool cats in the market microstructure world live in Paris. Their own endowment allocator head ended up making a fool of himself last year on Twitter. Dude, this whole thing with schools about like their schools, like they get state assistance and everything, but then they have these huge endowments too. And they're just making wads of money off of the endowments. It's like totally seems to me like there should be some changes made in our school system. I don't know what the changes that need to be made are. I don't think that I would support, completely publicizing the private university system or whatever. But like they need to change some laws, man. It's so frustrating. So like again, what I continue to see over and over again in society, like my thing is, I was a conservative. I've always been a Republican, I guess, but like I've gone through different stages of Republican because like I'll see things one way, and then sometimes you get your way, and then it doesn't end up working out very well. That happens. So for instance, having somebody like Donald Trump in to shake things up seemed like a good idea, and maybe it was a good idea. But there's a lot of entrenched interests in Washington that kind of make that kind of way of going about change really difficult, right? So it didn't really work. What will happen to most people is they'll be like, oh, I was like really liberal and like super Bernie, and then I realized that was dumb. You hear those a lot, right? Well, they think that it's an indictment of like liberalism or Bernie or Democrats, and there are people that go the other way. They were really conservative, they went liberal. What it really is it's an indictment of ideology. Ideology is just not a very good. These ideologies, political ideologies, tend not to be very good at understanding complicated systems and being able to solve them. The way that you need to approach these kinds of problems, these are structural problems, is with science. Is like the same way that we study market microstructure. You just apply microstructure to more political systems and civic systems, right? And then you can say, here are the problems and here's the change that we make. And based on our math, here's how that's going to affect that particular market or dynamic to improve it, right? That's how you have to go about it. And the answer that you come out with does not really conform to any one ideology or the other, right? That's where we need to get people, is we need to get them beyond the ideology into the actual science of things. But for some reason, most people never get there, When I changed my affiliation to independent, it caused my mom a lot of distress. That's funny. Yeah. But so anyways, because people have these ideologies, it also makes it very difficult to change things. Especially when people, the demagoguing, right? Because anybody who gets into office then can't actually change anything because people oppose it too much. It's a problem. Okay. To answer your question, I'm German. also focus on quant finance, but maybe also because of my age, I have this big question in my head. Are there any order that left that are traders as we think of them, or are there only quants and fundamental traders? Oh man, so the thing is that like an institutional trader can mean a lot of different things. Okay, so a lot of the stuff that I teach about on my channel is kind of more about how block traders trade. So a block trader is somebody that either they're trading for like an index fund and they have like a certain amount of S&P 500 shares that they need to buy up that day, or they have block trading desks at the banks where hedge fund will say we want to buy this much of something, but it's a lot and we know that you would be able to execute it more efficiently, so you sell the shares to us and then you're going to go out and buy them out on the open market, and they try and make money on providing that service, right? So that's the block trading desk, right? And there's a lot of quantitative sort of stuff about that, but there are also people that's what their job is they go through and they do all of the math and they talk to the people and they decide what the price is going to be, and they do all of the math to figure that sort of stuff out, and then they execute it, right? And a lot of those executions that happen are like algorithm assisted, so they still have a DOM up, but it's just that their DOM has a bunch of other features that are doing stuff that like constantly putting bids and offers out there to save a spot in line, things like that, right? So that's one way of doing it, right? There's also the world of like HFT where like humans aren't really competitive at all anymore, right? Okay. That you could work for a hedge fund, right? So a hedge fund you might execute just for them directly, and that would be kind of like block trading. Then there's the other thing, like kind of more like what Akshay did, where you're on the FIC desks, and a lot of the instruments that you're talking about are kind of like really weird esoteric instruments that don't have large digital markets for them, and so you're often talking to people on the phone maybe, or you're doing over-the-counter stuff or over-the-counter systems. Like there's just a lot of different trading, right? And different players in the markets that you'll interact with, right? I personally, because the way that I trade is kind of more speculator, I've been starting to trend more in the asset management direction, being an investment advisor and or running a commodities trading advisor where you just invest in my fund and then I would trade momentum on the treasuries or something like that, right? There's a lot of different ways to do it, and the deeper you get into it, probably the better of an idea you'll have of what you want to do. But I find them all really interesting. Regulators are very jealous about foreigners tarnishing German businesses. Really? I don't know too much about the Germans, but the way that all of the other Europeans talk about them makes it really interesting to me. This is really interesting to me. How do the OTC guys get their prices delivered since they are an interbank and not an exchange? Well, so there are like over-the-counter exchanges of sorts where like you, instead of having like a central exchange where you set everything up, you just have like everybody using the same program and putting quotes in that way, and it's weird. If you go by the books, there is an observation window which references the public market quotes. If you don't go strictly by the books, well, let's just say it's an open kimono. But this is also another reason why, like, especially in the fixed income market, pricing things is like a really critical thing, right? Like they put a lot of effort behind being able to come up with a good price for that weird instrument, and not only coming up with a weird price, but being able to come with that price extremely quickly. That's what I'm not going to dig it out of the stack, but that's what that high frequency trading book that I have is about, right? So he kind of goes into kind of the little secrets that they do so that they can do those valuations quickly, which often involves like caching data. So the dollar saw a little bit of a jump there from 103.95 to 104, and that caused the treasury market to tick back down a few ticks. I never really saw anything there at the highs or anything that was like a really big red flag to me that like I would need to take the profits on this sort of thing. I did build myself a pretty good profit here off of this. I have to say that the kind of the doing the market making and then trying to let it run sort of a trade has been working really well for me lately, almost suspiciously so. The biggest advantage for OTCs is you can get a fixed price for any amount of volume you want. Well, anyways, but point was, yeah, there's lots of different types of trading. I wouldn't worry too much about that. What I would worry more about is like figuring out which school you can go to. So if you're in Germany, that helps. But actually, I would have to tell you that which school to go to in Germany. Unless you know French and you're rich, then go to the University of Paris. or the Dutch one that he talked about. Well, he traded for a bank in the UK. See, did you notice how the answer that I gave about the OTC market was really just because I was familiar with a trading application that was OTC, and that was really all I knew about it. Oh, I heard gossips behind my ears. Do you think about switching to Sierra charts? Not really. So, I was thinking, but going back here before we asked that question, wasn't there another question about that we kind of maybe spaced over? Maybe not. We're talking about spoofs. We were talking about. Oh no, somebody did ask me a question. I'm sorry. Who was it? Somebody asked me about do you get into ICT stuff? Yeah, Osmond was asking me about ICT stuff. I think that ICT is a narcissist that's created a cult of flying monkeys around him, and I would avoid it at all costs. And almost everything that he teaches is just rebranding of other concepts that we already kind of know don't work very well. Most particularly Wyckoff. He is also like has a penchant for drama, and you can go back to Baby Pips, for instance, and there's been like this huge long thing that like will literally take you hours to read about all of the drama that he caused over there. So I would steer clear at all costs. There's a lot of people trying to promote his stuff out there. And he's been doing pretty okay on YouTube, but I would stay away. And I get kind of nervous talking about this because he's the kind of guy that will like try and start drama and come after you like that. But I feel like that my obligation is to tell you guys, you know, what we know about it, because in the futures world, he's not as well known. In Forex, he's very well known. So if you really want to read stuff about him, go and find the threads on the Forex subreddit or the Forex communities like Baby Pips. Okay. Does anyone else have the problem of depth level not showing up on the DOM for Jigsaw? It'll show me like 4 offers and only 1 bid where prices is trading. Oh, that's kind of weird. Unless it's like a really thin market. But if it's doing it like on ZN, then there's something wrong. Okay, so anyways, do you think about switching to Sierra charts? No. And here's why. The big advantage to Sierra charts is that it's written in C++, and they have incorporated a large number of features into the product that you actually get. And if you were trying to trade some sort of moving average strategy sort of technical thing, then I could see how all of those things would be very, very attractive to you, right? But under what we know about the markets, if I'm using a chart, I want to be trying to do something on the chart that not very many people do, right? So it is a lot easier to develop on NinjaTrader yourself in C Sharp versus C++. Not only because C Sharp is just an easier language to deal with, but because Sierra Charts doesn't have the best API, and there's lots of things that they probably could have written and they didn't. So it's like you're doing everything from scratch, which is really sucks. Okay, and so that means it's harder for you to write stuff, and that means that there's less like custom stuff out there for it too. At least compared to NinjaTrader 8. It's not like there's nothing, but there's not nearly as much stuff as there is for NinjaTrader 8. So I don't really think that Sierra Charts really gives me any kind of advantage. And the advantage that the platform that NinjaTrader gives me does give me an advantage. So yeah, well, so to the point that NinjaTrader is a bit buggy, what I have found is that when I first started, it was definitely buggy. And but a lot of the bugginess had more to do with people wrote these weird indicators that just didn't work very well. There was some real problems with some of the custom indicators that people had written, like the more sophisticated custom indicators, like if you were trying to do a footprint chart or something like that, right? And I would say about a year before the pandemic, the NinjaTrader's stability started to get a lot better. And so I find now that NinjaTrader is 100% stable unless I'm dinking around with a new indicator. So now it does use some extra resources because it's C Sharp, but if your computer has 16 gigabytes of RAM, you're definitely going to be able to handle that. And the other thing though is like the big negative to NinjaTrader 8 is that its DOM sucks and its execution sucks. So just don't use it for execution. And that's all it is. It's like it has that one big negative. Don't use it for that, right? And so now I can use NinjaTrader for all of my custom indicators and, you know, all of the other things that platform can do without having to worry about it crashing on me or, you know, it hampering my execution because I am doing all of that through Jigsaw. So, yeah. I mean, more to the point, like, because here's kind of the thing is, like we were saying, do you ever think about switching, right? Well, if you spent money on NinjaTrader, you know, like you spent $1,000 on NinjaTrader, why would you all of this abandon that and then start paying a monthly fee on Sierra Charts of $30 a month to get the same functionality, right? That doesn't make much sense. Why don't you use a footprint chart? Well, you know, there might be some situations where like something weird happened overnight and I want to see like what the volume that actually traded there was doing and everything. But kind of going back to what we know about the order flow, there can be aberrations in the liquidity that can kind of draw price to certain locations, right? Like when we have low resting liquidity and so forth. But those holes tend to heal after about 45 minutes, right? So trying to take a footprint chart, what they're trying to do is they're trying to look at things that happened like a long time ago and then say, oh, that means that I need to watch this spot when we come up to it again. It doesn't do anything. So, I think that most of the kinds of strategies that people try to make out of footprint charts are kind of flawed. They have an incorrect understanding of markets and are fundamentally flawed. That's not to say that footprint chart can't display useful stuff to you. It's just that it's like I really only find it useful when there was something that happened a long time ago or over a long time frame that I'm trying to look back on. So I think it's nice to have a footprint chart that you can refer back to, but not one that you need to have like open all the time and stuff like that. Because I'm more concerned about what the current conditions are, and the best way to see that is with the DOM, right? Switch to TT full suite and spend $1,500 every month. There you go. Oh, really? I found your channel because I wanted to learn how to edit indicators in NinjaTrader 8. There's one indicator that I use in NinjaTrader, opening price, which is bugged. The colors don't stick and it throws errors. Wait, is that a custom indicator that you found somewhere? I could take a look at the indicator if you were able to get on Discord and send me the CS file for it. Now you're saying it came with NinjaTrader? That is weird. I'm not too happy about that trade coming all the way back. I think that the prudent thing for me to do is to scratch that last contract, but this one didn't really give me the same kinds of signals that normally we would get. It flipped because of the dollar, so I probably should have paid more closer attention to that. If I was doing that as a live trade, I would hope that I would have paid closer attention to that and made more profit out of it. Can Python be used for all coding projects? I heard it was the easiest one to learn, just trying to understand the coding craze due to my son's interest. So if not only is Python easy to learn, but Python has a highly developed ecosystem that is particularly useful to quantitative finance work. Okay, there are disadvantages to Python. For instance, it's not as fast. What happens at a lot of quant firms is they originally write all of their strategies in Python, and then the strategies start not doing as well, and they try and rewrite everything in C++ to do it fast. But for what we as retail traders are doing, like Python is a really, really great place to start, yes. Or C# and doing it through NinjaTrader. The thing is if you do it with Python, you're going to be like going and getting a data feed and like doing everything from scratch. Whereas with C#, you can utilize the NinjaTrader 8 platform and backtester, which is really useful, right? Anyways, I'm trying to do open price. DOM combined with the footprint is the best, if you say so. I guess the thing that I want to see is what is this behavior that I can only see on a footprint chart that we can prove is a real thing, I've never seen it. I see a lot of interesting ideas, but what is it? It's not open price. It must be current day open, high, low, close, maybe? Current day open, high, low. They do have colors. I would use open, low, high is what I would be using. And then if you want it to be, so let me show you something else that might blow your mind. Okay, I did get out of that, by the way. So if you come over here into NinjaTrader Control Center and there's tools, trading hours. Where is that? I'll pull that over here. So here you got trading hours, right? And so if you're doing equity indexes, right, then you're going to do US equity index futures RTH is going to be, or sorry, ETH is probably going to be your default, right? Which will give you like the whole overnight session. But then you're like, okay, but what did they actually open at on the open, right? So you can do this, and you could just set it up yourself, or again, if you message me on Discord, I can send you these. But here I have one, and look, it says on Monday, there's also, this is all Central Time, okay? So it's saying, okay, there's an extended session that starts at 4:30 and ends at 8:30, and then there's a regular session. And then there's this little small end of day session after that. And then you get the start of the next extended session. So it's a multi-session template, essentially. Okay. So here I have my open, high, low, close, right? It says that the open was 4,007. Oh, that might have actually been when the regular session start was too. But if I come into data series, okay, and I change my trading hours from use instrument settings to that one that I had there, the index futures quant edge setup is what I did. Right. Then it should, oh, maybe this one, maybe that particular index, man. Now I feel dumb because I say that and it didn't actually work. Hold on. Is there settings here for this? So you can see it drew a line at the start of that session. Yeah, it's current day. What we need is a current session open, high, low. So there's other ways that we could do this though. Like I said, the one that I like is this lizard indicators like opening range. And it just allows me to specify the time, and I can put a line on it where it happens. See that? And then I can see exactly, okay, the open was at 4013, right? There's got to be another one. But that opening price, this is, yeah, when you get into like indicators that are based on that they have to read into the session, you get into all sorts of really bizarre edge cases. So they're kind of hard to program. So it wouldn't surprise me if you downloaded an indicator about that relating to that sort of thing off the ecosystem that had problems, right? But lizard indicators opening range one is really good, right? And it also shows you what that opening range is, which is kind of nice. I don't utilize opening range in my trading, but again, that's one of those ones where it's like, okay, prove to me that this actually works, because I went and back tested it and it didn't work. Maybe that's another one that we should do. The problem with opening range. I don't know. The problem with opening range is more that it's a fat tail distribution, right? When the opening range strategy doesn't work, it like really doesn't work. So the kids have late starts, so I wonder, I don't know what time they're going to be starting though. Brannigan Barrett 4 minutes ago, reading my mind, the Bitcoin crowd are not immune to higher rates. The stop run starts at 23,500. Yep, probably. They are down on the day, by the way, Bitcoin. Did I close that chart? Yeah, I did. All right, cool. Anyways, it's just like with all of these things, it's like I find footprint charts really interesting, guys. I find them really interesting. I think you could do some interesting things. You know what I want to do? Here's the next project that I was thinking about doing. Let me tell me what you think about this idea. So, somebody was posting on the Futures IO board, and they were saying they were doing cumulative delta and Sierra charts, and they're like, how come my cumulative delta and Sierra charts is like the exact opposite of what I see the cumulative delta doing on other platforms? Well, it turned out that there are multiple versions of cumulative delta on Sierra charts, and one of them does it based on trades. So like if somebody buys 500 contracts all at once, it just counts that as one trade. Although I think that they're probably showing the matches, not that, so they're showing the limit orders, hence why it's the opposite or whatever. But it was really interesting to me because it was showing me, it was showing situations where there were more individual trades going in opposite the move, but there was more volume overall in the direction of the trend, which kind of suggested that the people that were buying were using larger orders, right? So what if we did this? What if instead of showing like a footprint chart and all of that sort of stuff, where it's like, here's how much happened at each one of these prices, what if instead we drew a distribution of the size of the orders? And at each candle, you would see a distribution of the size of the orders so that you could see if one side was using larger market orders than the others. I think you would have to reconstruct the trades to do this and everything, but like reconstruct the trades, reconstruct the market trades, and then graph the distribution of the market orders. What do you think about that? That might be interesting, right? But these are all, they're just kind of interesting. Like, can I prove that actually means something, that you can, like, it adds something meaningful to your trading? Well, I can't prove it. Well, I might be able to prove it. I might be able to take that and then, do a back test with it and show over a large data set that it actually is really useful, right? But how do you... That's a complicated thing, right? Is it possible to integrate data from outside Ninja? Yeah, absolutely. It is. You can call any kind of API or whatever you want with C, as long as you can write it in C# code, you'd be able to pull it in. How can you get years of historical data in NinjaTrader? Well, so your broker probably has limits on it, but if I'm doing like daily data, they'll usually let you pull like 10 years of data. If you want to do, for me, for Rhythmic, they'll give me 1 to 2 years of like historical tick replay sort of stuff. So I can still do, but I can't do it over 5 years. I can't backtest order flow stuff over. So like the one that we're talking about right now, yeah, wouldn't be able to do that over, wouldn't be able to do that over multi-year period. In fact, the more that I think about it, I think that I have to have live data to reconstruct trades, right? Because the way that you have to reconstruct the trades, I think, is you get a bunch of volume, and then you say all of this volume was part of the same order until I see the accompanying level 2 change. ID feed. Oh, well, so when you're getting matches, when volume comes through, the way that it works is it says if there was like 2 orders in here, one was 1,000 contracts and one was 200 contracts, okay, and then somebody came in here and sold all 1,200 contracts that were being bid at that price, right? Then you will get 2 updates in your market data feed, one for each of the limit orders that got filled, right? So you have to see what the market order was, you have to reconstruct those, because I believe the way that it works is you'll see 2 market data events, but you'll only see 1 level 2 update. Oh, IQ feed. IQ feed might be able to give you more data than that, yeah. My issue has kind of been that when I do my back tests on the historical tick replay data, if I'm really trying to do something HFT-ish, it's not effective. Like in that situation, like let's just say that I'm doing it on 30-second bars, or let's just say that I'm doing it on 1-minute bars, right? And I'm looking for like some sort of certain threshold to hit. You know, the fact that it hits on this bar versus the next bar like makes a huge difference, right? And there is enough wiggle in the difference between the live data and the way that it calculates when you're doing it with historical tick replay that it really affects the performance of the algorithms. So I don't really trust the data I get back tested from that in general. Let's see here. Nick Timoros tweets, former Fed Vice Chair Rich Claridia, writing from his old/new perch at PIMCO on the Fed, our view remains that they've already done most of the heavy lifting they will need to do before they pause rate hikes later this year. Okay. Oh, hey, we came back up there pretty quick. Well, it wasn't too great, but I could have held that one, but I wasn't intending for that to be like a really hold it for a long time. It was more of a scalp, so I probably should have taken the profits on it earlier, but I was only in it for 38 minutes, which is about what I'd want to do. That one was frustrating that I didn't really get very good exit signals up at the top. Okay, and is backtesting with external data possible as well? Like if I had 3 years of historical sentiment analysis, could I backtest time series data in combination with that? Possibly. Okay, so now you're getting into something really complicated, Sebastian. If you're going to do that, you're going to want to be a good programmer. So here's the problem that I ran into with that stuff. NinjaTrader is a multi-threaded application and does not necessarily update things in the order that you anticipate. And while there are certain methods that do allow you to kind of deal with the multi-threaded nature of NinjaTrader. So for instance, if I'm writing a footprint chart or whatever the deal is, you want to go and get the price or the values by using like the get current bid method instead of trying to call the data series itself, because the thing that might have updated the data series itself, it hasn't run yet, but if you call the method, it will force that to have run an update, right? So if you don't do it that way, you could get oh, there's nothing there sort of an error, right? So you kind of get the same thing, which is like you should be able to go and grab an external series like cached off your disk or whatever the deal is and put it into your indicators and pull it up. And I think I had found a solution to that, and then I forgot what the solution, like I didn't go back and put it in the code. And I was like, I came across it in another indicator and didn't go back and try and fix it in my other. So I think that it's probably possible, but it's like, it can get really complicated at that point. That's the challenge there. But like, then that's the whole thing is like at that point, why not just do it all externally anyways? Why not just do your own, you're writing it in Python and do your own whole backtester sort of a thing, right? I mean, I've done some work connecting NinjaTrader and Python together, but that's only because I would have to pay extra to be able to connect Python directly to Rhythmic. So okay, so they did try and make that push back up to the highs. It's already doing some back ticking, so that might be sputtering out. I still see a market that's pretty tight and dull, and it doesn't look likely to do a whole lot until the FOMC. Yeah, no problem. My indicators, because they're doing level 2 stuff, because they're doing market depth, I want to be able to pull that information back up historically, and so they're like caching the data. They're like saving the data to disk and pulling them back up. And when I tried doing back tests based on that, that's the problem that I have. And I never went back and did them. In fact, let's write a post-it note about that. Let's write a post-it note about that. So did I show you my board here? I think I need to change it because I used like the big sticky notes, so I gotta really pull it back. I used the big sticky notes over here for songs, but I don't think that each song needs a whole sticky note. So I could probably get rid of this column and add more room here, but I was like, I won't worry about it until I really run out of room. So, but I probably do want more room because these ones down here, these tealish one, well, I would call it sea green ones, are tasks that I need to do like around the house. Oh, which by the way, we did this one yesterday. So I can throw that one away. Yes, I'm liking my little board. The next thing though is we need to finish that desk so that I have more depth so that it actually fits. How are spread charts helpful in price forecasting? For example, if the 2 10-year spread is graphed, how does that data translate to future price? Well, okay, so we already talked about how knowing what the spread is can help you interpret the order flow better, right? Because certain order flows you have to discount because they're coming from the spreads. But the other side of this is that what the spread is doing gives you kind of like another vote, if you will, right? So it's kind of like if I'm seeing interest rates go lower, treasuries are moving up and interest rates are moving lower, right? Okay, well, so I might think, oh, maybe something dovish happened. Like maybe we got some economic data that looked bad, or maybe a Federal Reserve member said something that was dovish, right? Oh, did my camera die there? That's funny. I didn't have the fan. I didn't have the fan running because I didn't have the fan plugged in. It was just running off of the battery. So the fan died and then the camera overheated. So I turned the fan, plugged the fan back in and turned it on. The camera should be fine. Anyways, okay, so the spread is kind of another vote, right? So but you know, the problem is you really have to know a lot about the treasury markets and like macroeconomics in general and everything to really try and interpret what the yield curve is trying to say to you and everything. But that's kind of where I look at it. And so what can happen is, for instance, I might think well, so like this is not what happened today, but this was one of the things that I was looking for, was like the Federal Reserve is likely to have interest rates higher for longer. And that not only will it be higher for longer, but it could be like, well, longer is like many years, like 5 to 10 years maybe. So in that world, 10-year treasuries should be worth a lot more than 3.9 compared to the 5-year, right? They need to catch up. That these really all need to catch up to like 5.5. Like if we're going to be in 2 years, we're still going to be at 5.5%, then like this 2-year price is awful, right? Okay. So I'm looking for interest rates to rise. Okay. But I would also be looking for the yield curve to steepen. Right? So if I'm coming in there and I see, well, we're not really moving anywhere, like things are kind of even, but I do see evidence of steepening in the yield curve. Either the yield curve is actively steepening or I'm seeing order flows at like complete opposites in two of the instruments. That might give me a good reason to think that maybe eventually price will bust out in one direction or the other, right? So that's still based on like informational content that I have from outside of the exchange, right? Because what I know about the current economic data and all of that sort of stuff, right? But you know, you can kind of use it as another data series to kind of figure out what's going on, I guess you could say, right? So if you're going to trade the treasuries, well, even if you don't trade the treasuries, I would always have something open that shows you what the yield curve is doing, and just start trying to learn it. Okay, today we steepened. Why? And then go and try and look for reasons why we steepened, right? And that's really valuable in the long run. But it's a complicated thing, and I don't completely understand why the yield curve does what it does sometimes. The timing in particular always seems really random to me. By the way, I guess I could have held that trade, couldn't I? 09. I don't remember what price I got out at. Oh no, it was at 09 that I got out at, but I think it was 11 that I was like, I would have preferred to get. And how much did it breach the highs here? Oh, it hasn't breached new highs yet. But still, I could have held it. Would have been almost double what I got, but that's okay. It's just a sim trade anyways. Oh, interesting. The CME Group plans to launch a nickel contract settled with prices gathered from a platform to be launched by UK-based Global Commodities Holdings, which could eventually compete with the London Metal Exchange, 3 sources with knowledge said. That's significant. If we had more metals trading over here at the CME and they were like a real competitor to the London Metal Exchange, that could be really weird. Or not really weird, but that could cause some interesting developments in our markets. You're thinking too much into it. Yield curve moving is just a result of buying or selling on a particular on the run. Well, it can be. Can be, for sure. But, you know, I might be able to determine what the case actually is from looking at the order flow, right? Like if they're all kind of just like just kind of chilling and not have that much volume, except for the 30-year is selling super, super hard, then that might be a good reason to say that they were just going short the 30s and that's all there was to it, right? There goes the spoos, party over. Doesn't look like they've flipped yet. Like they did breach 4,000, but you're gonna need to see a little bit more volume to the downside first before I would say like, oh, the CTAs are definitely all going short now. It's probably coming though. If you're talking about ZBs as really, well, no, I'm saying that they were coming in and selling the 30-year futures themselves individually, right? So I give you an example. The most bizarre thing I think I ever saw, and I think this was before you were here, Akshay. One of the most bizarre things I ever saw was there was a huge meta order long in the 5 and a huge meta order. No, it was the 10. It was the 10 and 30. There was a huge meta order long in the 10 and a huge meta order short in the 30. And like the cumulative deltas were like exact opposites. And the prices moved exact opposite. I think I've only seen that maybe like 2 or 3 times where the price in ZB and the price in ZN moved directly opposite to each other. And it was very, very apparent in the volume as well. And the next day, we found out from a report that a particular hedge fund had put on a really, really huge spread trade. And they had done it with the futures. And so that's what we were seeing, right? So that's kind of the example that I would give where sometimes you can sort out from the volume that you're seeing where a particular trade might be, what kind of a trade might be getting put on, right? Yeah, but this was way more different than what you showed me. Like this was like literally one just moved, like huge move, like like the chart that you showed me yesterday. I would expect to see that one be like ZN is up, 10 ticks, but this one is only up 5. Yeah, and that one was 12 months long. Okay, I'm talking about in the space of 5 minutes, the 10-year Treasury jumped 12 ticks and the 30-year dropped 12 ticks. Octavia says he remembers that day. Yeah, that was a weird one. I've seen it. There's at least twice. It's at least twice. I've only seen it twice. It's not normal. Is not normal. I've seen it twice. Maybe it happens like outside of our time frame, but I've literally only seen it twice that I can remember. The other one that I remember was the 10-year just stayed put and the 30-year tanked. But it was just the 30-year and everything else was sitting there. We're like, what the fuck? It was so weird. It was so weird. And I mean, it wasn't just like a little one. It wasn't like, oh, it ticked, this one ticked down a tick and this one ticked up. It was like 16 ticks or something like that. Like it was a big move. It was like like maybe a 2 basis point move. Do you think it would be worth building a low latency algo that takes advantage of the liquidity constraints and enters with a few contracts after a CPI release, for example? Maybe. You might, especially if you could get your algorithm to understand what the what the actual data release was. You might be able to find some, and it's like a good at pricing. You might be able to find some situations where you might be able to predatorily take liquidity out. Twelve ticks on ZN and 12 ticks on ZB, both opposite. You can see that pretty much. No, I don't think so. I don't think so. You find me an example. Find me an example. Because I've literally only seen it on the DOM twice. Okay, when? No, give me like the exact timestamp I need to look up. Now, go find it then. I'm saying that, like, you look at the two data series, right? And one goes up and one goes down, like at the same time. I've only seen like where they move directly opposite to each other. Two that I can think of specifically, and maybe it's happened maybe 3 or 4 times. Great, now I just need to know how to write code that analyzes a CPI report correctly in under 10 minutes, all right? like the kind of algorithm that you're talking about, Marcus, that sounds like something that you could, would be worth investigating as like the basis of a strategy, but you're also talking about a very sophisticated algorithm. Like there's a lot that you can do to make something like that work better. ZB kept making new lows over and over that day. Yeah, I don't remember what I did. I remember just being like absolutely perplexed. Like I'd never seen anything like that. And I couldn't for the life of me think of any reason why they would be doing that. And it was a weird one. UB was doing that this whole quarter as well. Well, you might find some small little blips here and there where UB kind of does weird stuff because it's so slippery. But like I if you can find me a place where if I plot my ZB and my ZN next to each other like this, we'll pull it up. Okay, so if I come in and I make a chart and I will add ZN first, and I'm gonna do 30-minute bars, no tick replay, 90 days. Okay. How could we do this? And then I'm going to add ZB. Same thing. ZB. This is also 30-minute, all right? Okay. Oops. Didn't load 90 days worth. This one needs to be 90 days. Okay. And then to help us out a little bit more, let's come in here and, oh, still loading the historical data. Hold on a second. Okay, hold on. Oh, look. Oh, god damn it. I fucked it up. No tick replay. I don't want to do 90 months of tick replay. That would be stupid. Okay. Okay, and it does go back far enough. Then I'm going to add on here one other thing to kind of help us out a little bit. I will add a correlation indicator. Where is NinjaTrader's correlation? Correlation. Count it then. Instrument ZB0323. Okay. Okay. So you said January 4th through 5th. Okay. Well, so for instance, here's a spot where they kind of weren't very correlated, but you can see that that was just like not the same thing. Here's one where they weren't very correlated. Here on this one, it looks like they both moved down, but the ZB recovered a little bit faster. No, I don't see one on that day. So again, we're looking for a bar where we see on this chart a really big orange candle, well, actually it would probably be, well, it could be either or, but they literally move opposite of each other. Has the volume in the stock and futures market increased since 2008? It seems like a lot more people are trading nowadays. I mean, it depends on the market you're talking about. I would say that overall volume has increased, yes. But especially in the S&P 500 futures, the resting liquidity is a lot less too, because the price has gotten so much higher. So there's like a lot more seeming volatility for us as retail traders, right? Like it used to be that you could go and trade just 4 ticks, right? And now it's like if your stop's not like 10 points. Anyways, so he also mentioned January 22nd to the 23rd, or December 22nd to the 23rd. Well, I don't know if that one should count because that's like right before Christmas, but I'm still not seeing. Do you understand what I'm talking about? Well, there's one. Oh, well, that one's close. See that bar right there? It's a blue bar, and that one ends up being just a little bit of a doji, but that's still not. Like I'm really talking about this one. It moves up and it closes at its high, and this one moves down and it closes at its low. That's what I saw. I wish we could. I wonder if we could go back and find it. Might be hard to go. Well, we'd have to really go back. Okay, now when I zoom all the way out here, the biggest divergence that we ever saw was here, here, and here. But let's zoom in on this one that happened on December 1st. No. So this one, there was a divergence here, but it was just one moved a lot more than the other one. Oh, well, and here again, it's kind of like a little bit of a doji. Small candles. That might be different if you do it on actual yields, especially if you do it on actual yields on like broker tech, right? Okay, I think it will be able to handle 5 minutes. Let's see. Yeah. Okay. To make things a little bit easier on us here, though, let's limit it to RTH. Okay. Interest rate RTH. Interest rate RTH. Okay. So here's a divergence here, but that's like right off of the oven, so I don't know if that would even count. That one's kind of a weird head fake, though. Some of these, it's like I'm not quite sure why it does it that way, because it doesn't look like anything significant is happening there. But you notice, like, if so we come back out. So here we're looking at like 5-minute charts, right? Okay, maybe one spot right here. Well, that was just the break of the day, though. Like, where is a spot where it actually goes literally negative? Hardly ever happens. And the places where I do see it going negative, it's like teeny tiny little ones. Right? Wonder if I change my so what happens if I put the correlation here count to just 1? Does that work? No, you can't do just 1. I want to know, like, how much did this one move compared to this one? So you get these spots where, like, they'll spike, but, like, look, they both spiked up. There's just one spiked more than the other, right? Oh, the correlation indicator is included with NinjaTrader. It's just called correlation. You have to come in here and put a count in it. So we could say like 30. It's actually, if they're 5-minute bars and we want to do a 30-minute correlation, then we should just do 6, right? I don't seem to see the place you're talking about though, actually. I mean, I'm literally talking about a spot where's my pen here? Can you hear the fan in the background, by the way? I mean, I can hear the fan in the background, but maybe you guys can't. But I turned it on pretty high. Oh, that's not the one that I wanted. Even though presentation pointer is cool. Oh, darn, where did it go? I don't have my pen. I can't draw anything. It's hiding on here somewhere. Hold on. I won't find it. I'm gonna find you. Oh, it's almost time to go. G ink. There we go. Okay, look at December 22nd. Because I'm literally talking about something where like this one goes like this and this bar goes like this, right? And they were big moves too. It was a big move. Okay. December. Oh yeah, okay, we do go back that far. December 22nd, 6 a.m. Eastern time. Well, that was like a more specific, but I don't see the one you're talking about. Was that 6 a.m. Eastern time, perhaps? Then it's not showing up on our RTH chart. Let's go back and change it back to use instrument settings. Use instrument settings. 6 a.m. Central time. Okay, so 5 my time. Am I looking at the right day? Am I looking at the right day? Because the time period that you're talking about, it's only floating around like 2 or 3 ticks. I don't see it. Do you see it on this chart right here? So like if I come back over here. Are there any guides that show you how to build low latency? There are a lot of books about this sort of thing. So, not about the one that you're kind of talking about, though. But there are definitely books about this subject. I'm betting you'll see at least. Okay, that would be if you write me an option contract for that, I'll take you up on that one. There has to be 7 moves where within a 5 to 30 minute period, the change in one is positive and the change in one is negative by more than 8 to 16 ticks. That's what it would have to be, right? Where'd G ink go? I mean, like, I'm talking about, like, you're getting these bars like this, and they're both kind of going, like, sideways, right? And then all of a sudden, this one goes good dish, and this one goes good dish on the same bar, right? And then after that, they're still correlated, but like, complete opposites. More than 8 ticks, yeah. I would say the ones that we're talking about were a lot more than 8 ticks, but let's just put a threshold of 8. Because just looking on the last 3 months, I can't find one, right? If we had a bar like that, it would really, you would see it here on like our correlation indicator, where you'd get like an almost negative correlation, right? But we're not really seeing that. The correlation stays positive. Right. It would be hard, like, would we have to like qualify it by like the candle itself, you know? It's like this candle, the open to close is up 8 ticks, and this candle, the open to close is down 8 ticks, right? At least 7 instances. Okay, but the first thing though that I would focus on if you want to do this is you need to find me one instance of it in the past, because I pulled up the chart and I'm not seeing one. And we're saying between the 10 and the 30 year, right? We could do it on TN and UB, but I meant ZN and ZB. Like, let's say that it's on the knob spread. Okay, so like another way of saying it would be the knob spread moves 8 ticks, but the 10 and the 30 were moved in exact opposite directions, right? Because you definitely will see a situation where like ZN will move up like 3 ticks and ZB will move up 11 ticks or something like that. Like that happens all the time, right? That's an everyday occurrence. But one where the ZN moves up 8 ticks, the candle closes up 8 ticks, and the ZB candle closes down 8 ticks, or whatever it is. I'm telling you, I've seen it twice. Literally twice. Or like, to put it another way, you're watching the DOMs here. I'm just going to close this chart now. So it's time for me to go. You're looking at the DOMs, and like, this one will be like way, you know, we had them centered, and then this one is way up here, and this one is way down here from when we centered them. Okay, anyways, I got to get going. Let's set the title here. Tight markets ahead of FOMC minutes. All right, I will see you guys tomorrow. In the meantime, stay excellent, team.